I found myself in a position where I was listening to bankers directly and I could hear their pain points. I always made it a point to keep their names out of it when I would take things back to the agency. What are you hearing from the bankers? Here are the issues, here are the challenges. Well, where'd you hear that from? Not going to tell you. Bankers came to DC and would ask questions. I really became a good translator because I could hear the question that was being asked on this level. Really, what they wanted was here. The answer they were getting was here, but it was really learning from my teaching background that in order to be a really good teacher, you have to be a good listener.
Welcome to the Operate podcast, where we give you a behind-the-scenes look at company building from the perspective of the builders themselves. This is how we operate.
Welcome to the Operate podcast. I'm Kerry Ransom. Today's episode is sponsored by BankTech Ventures, the first strategic investment fund designed by the community banking industry for community bank innovation and investment. BankTech identifies leading products and technologies for community banks and works with the founders and management teams of those companies to maximize the impact for community banks as well as their businesses. If you're a bank looking to innovate and invest in the future, or a founder who wants to work with community banks, reach out to BankTech Ventures at banktechventures.com. My guest today is Rafael DeLeon, who is the SVP of Industry Engagement at NContracts. And they are one of the leading software companies in the financial services industry, particularly with a focus in the areas around compliance. Rafael is also on the board of directors of Main Street Bank in Virginia and is a former bank examiner and executive at the OCC, where he spent much of his career in a number of roles there. He's a super strong advocate for the banking industry, its importance to our economy and society, and how effectively working with regulators allows for both innovation and a healthy system. We're going to talk a lot about that today, as it's not always so apparent to everyone. It's been such a pleasure to get to know him these past few years and develop the partnership that we now have. Rafael, so glad to have you here. Thanks for joining me today.
Thank you for having me, Kerry. Look forward to our continued conversations.
Absolutely. Glad we could finally record one.
Yes.
So let's start with sort of one of the hot topics of the day, which is banking as a service. We have a number of banks out there that are getting regulatory consent orders, and there also are a number of fintechs that have relied on them that are really struggling as the venture capital market has dipped a bit in willingness to fund them, as well as some of just the business model fragility that I think some of them have. How would you describe what we've experienced and what's gone wrong there?
It's a great question. And I think it's easier to look back now that we have a little, several years of history on where banking as a service has evolved from. And from my vantage point is where I really started seeing this. And we go back to seeing and remembering hearing fintechs talking about eating the bank's lunches and taking market share away from them. And yet we saw that banks have the credibility, but more importantly, the trust that they have on their side. When things have gone bad, people have known, oh, my parents didn't lose money in a bank. We haven't had these other issues. So there's that trust aspects. And the fintechs didn't really have that coming on. They didn't have a source of funds, a stickiness, of deposits, which banks have. So we started kind of seeing that fintech started approaching banks and saying, well, let's partner. Instead of us trying to cannibalize, let's partner that and let's figure out how we're doing. And I think in a lot of those early scenarios, those were good working relationships, but I really refer to that period as the Wild West. And as we think of the Wild West, terms and issues are kind of dictated on the fly. And here's what, I can do for you, and here's what you can do for me. And I really think that for a lot of these banks that started moving into working with these fintechs, saw a great opportunity, that one that hadn't been presented to them before. And each fintech that they were partnering with was saying, we need X, Y, and Z from you. We need connection. We need an API. We need, this. We need all these different things from you. And we can provide you this revenue source. So people, I think bankers saw these things and said, let's start working with it. Let's start building this and see how it flows. A lot of those things became very operational profitable. The challenge was, in my mind, is that fintechs were dictating the terms to banks and basically saying, hey, you need to provide me this and provide me all of this access, and we'll get you this, and you're going to get this money. And I think anybody that was just first getting into this, there was no model for it before. And what are we looking at and how are we doing it? And I think there were some very, successful partnerships that came around and some banks that started moving into that well and also very quickly. But what I would say is that is the kind of challenge that where we are now. We have moved from that Wild West environment to we've seen, especially with the current administration, there's new sheriffs in town, there's new regulators and some, old ones that are, reappeared again that are at each of these agencies that look at risk in a very different way. We've seen that from each of the regulatory agencies. The bottom line, especially with a bank that I learned as a young examiner, is the bank is responsible for anything that happens within the bank. And these go back to even older problems that I saw with banks, years ago, especially when banks would outsource something like flood monitoring and flood maps and looking at those and, who's in compliance with it or who's not. And maybe that company did not do a good job, but yet the bank was ultimately responsible. And we saw, evidence of that, 20 and 30 years ago when people would outsource. And being a director, I can also tell you, a director cannot outsource those responsibilities to another institution. Directors have two really main fiduciary duties, the duty of care and the duty of loyalty. And that duty of care is so important in terms of how do we care for this institution and how do we care for the stockholders, the shareholders, the depositors, the community, and most importantly, taxpayers? What are we doing in that? So we can't delegate those responsibilities. Board members cannot delegate those. So those go back for years. And I think that was some of the pieces that were missed early on with banking as a service fintechs that were partnering with banks. So we've kind of come full circle in that now what I see is a primary driver, and that banks that are starting to move forward with banking as a service are saying that they have to dictate the terms and they have to make it very clear who is responsible for what in this relationship and how is that going to be conducted.
I think that is a great history lesson as well as kind of where we are now. And I don't think it's apparent to a lot of the parties involved out there that, to your point, a lot of the fintechs came to these banks saying, hey, we'd like to partner with you and kind of hire you as a bank to be a service provider to us. And yet, to your point, the regulators look at this as the bank is hiring the fintech as an outsourced provider. And those are almost two completely different relationship contexts that these two parties have walked into, and now that has to get sorted out. So do you think we'll see more standards getting created where it is pretty consistent, or do you think that banks will have an ability to really differentiate and stand out in how they do this moving forward?
Yeah, I don't know if it's necessarily going to be standards that are going to be done. I think they will in effect become standards because people are seeing that they're moving the right way. Let me jump back, because when we think of standards, and having been a regulator, people are often, hey, what are the regulators wanting? What are the regulators expecting? And as banks were moving in this area, I liken it, the analogy that comes to my mind is the baby that is learning to walk, and you see it, it's all happy and everything, but it goes to a certain point and is looking around like, am I okay? Did I go too far? And we always want to know, are we too far out on a limb before we fall? And, help me before I get a little further, because we're too far into this. When you have emerging technology like this, the regulators are learning really at the same pace and understanding it. And I think one of the good things that the regulators do is not come down very quickly with standards to say it has to be done this way. It has to be and be very prescriptive. What I saw, from my perspective, is the regulators are good at identifying the boundaries. And let's look at this from a policy point and say, here's where we're going to operate within this. We just, the regulators just issued an updated and consistent guidance among all the regulatory agencies for third-party risk management based on what the OCC was using for many years. And a lot of our banks had been through that process and done well. Some people I've heard saying it's too prescriptive, and yet I like to say it's descriptive. It gives me a way of looking at, hey, do I have this? Do I have this? And different ways of thinking and asking questions to be able to answer those questions. And it's not just a simple yes or no or check the box. You have to really think these things through. So I really think the challenge when it comes to that is absent the regulators and absent, what we're seeing, whether it's with third-party risk management, we have guidelines now, or what we're seeing with AI. There's still a lot that's out there. But I think there are three main components that were challenges for dealing with third-party risk management. And that is the compliance and regulatory oversight that fintechs really didn't understand that. They weren't built to understand that. They were built to solve a particular problem. And I think they were wanting to partner with the bank to say, hey, you've been dealing in this regulatory world, help us. And yet the reality is most banks have a challenge keeping up with their own regulation and compliance, not as much as managing somebody else. And now you've got 10 vendors or you've got 10 other areas to look at, and how are they handling compliance and regulatory oversight? There's different models in terms of how that can be done, but I think that part was missing. And hey, how are you doing this? How are you staying in touch with this? We saw the evolution of it, and we see that where banks started doing more testing and on-site testing of vendors and asking them more in-depth questions, doing a better job with due diligence to really understand how that fintech or partner was handling any compliance and regulatory oversight. I think the next big question is when you're dealing with any company, and because it's the business of banking is risk management, asking somebody else, even yourself as a borrower, or when I've been a borrower, tell me, about your risk management. How, risk averse are you? What are you into that it is creating risk that could impact you and your life or your cash flow? What are these things that we need to understand about your business that you're doing, and how is it faring? So I think, again, that the compliance and regulatory oversight, the risk management, and I think more crucially, and this is where, NContracts, and I'll, just make our plug-in, where we do a really good job is on those two areas. And the third one is on third-party risk management, looking at their vendors. So as I've gone around and started talking to any vendors, any fintechs, one of the questions I've asked them is, how are you looking at your third parties? And I remember the first time I started asking that question, the one person looked at me and was like the lights just went off. And he goes, oh, we're not. And I said, if you're really going to differentiate yourself as a bank, and I'm a banker and I'm looking at several basically resumes for fintechs, and you're all basically doing the same thing, but now you're telling me that you speak a similar language I do in terms of you're looking at your third parties, which, that fintech's third parties are the bank's fourth parties. And that becomes that kind of rat's nest, if it were, to try to unwind and understand that. And so I think it's those three areas that if you're speaking the same language, you've eliminated a huge risk for a banker in terms of how they're looking and evaluating a company and what they should be doing.
So good. So much useful perspective there. Last couple questions on this topic. There are about 100 plus or minus banks that are out there purporting to be working with fintechs in some form like this. Some of them have one or two partners. Some of them have hundreds. And I'm curious on the kind of last couple thoughts. Where do you think this ends up, Rafael? Do you think we end up with just a couple dozen banks that do this really well? Do you think this becomes a line of business for hundreds more banks and they figure this out? And what's the right number of partners, because to your point, risk management does get multiplied if you have 5 fintech partners versus 500. How do you sort of manage this in a proper risk management way? So curious, number of banks, and then, how do they operate in your mind moving forward?
So I think one of the reasons that maybe there's I've seen numbers from 120, 130 roughly
Yeah.
that are involved in strictly banking as a service and what they're doing there. I'm an eternal optimist. I think that banking as a service and partnering with the fintechs is part of the survival of the community banking system and how it is going to continue here in the US. So I'm optimistic that we're going through a transformation right now in terms of where are things at. And you and I both know that especially most fintechs and most banks were waiting for the agencies to come out with the third-party risk management guidance. And that took 2 years for them to kind of pull together what was already there from the OCC and really didn't change all that much into what took 2 years for them to finalize. So once the rules of the road became much clearer, then people got in. Now we're in the situation where we find ourselves that we're having to kind of learn through enforcement actions that these different banks have come under. And I've always said this throughout my career, banks should use enforcement actions as a blueprint for action or a blueprint for double checking. What are we doing?
Sure.
Do we have any exposure on this? This just happened to a community bank down the street or even a large bank. And they got hit with some areas around bank secrecy and anti-money laundering and counter-terrorist financing, all those areas. What are we doing? What did it tell us in there that we can use to learn from ourselves? So I think that is part of the issue that we're seeing. And I think as those things become clearer and the banker has more expectations upon the fintech, and that relationship becomes much more transparent, spelling out in their contract what the controls are going to be and using the contract as a point of control, who's expected to do what by when, who's going to be responsible for things, how is compliance going to be handled. I already know of several different banks that are already building in compliance into their banking as a service model. And there are others that are kind of on that cusp versus some of the others that we've been looking at with current banks that are looking at what somebody else was doing. And one of the flaws in that ointment was middleware providers. And some of these middleware providers said that they were looking at compliance, and we're seeing that wasn't happening. And we're seeing a lot of other issues with middleware providers that you and I could spend another hour talking about.
Sure.
But I think that area is where it's falling. That's going to fall apart. So we're seeing through this kind of transformation, some of these things are working and some of these things are not, but we're not seeing people just jump completely out of it. And they're not, because they either have the systems or tools that are built. But one of the things that I think is important is, and this is where I think the transformation is going to take off differently, is if banks already have good risk management, compliance, and third-party risk management systems that they've already built and tested, that is much easier to expand, especially if it aligns with what their strategy is and that strategic alignment. I just there was an article and I was quoted in the American Banker, and I really think that has kind of been one of the keys and one of the flaws in the ointment is not having a very clear-cut strategy of where you're starting from and where you're going to end up.
Yeah, great points. And, I have heard from some of the banks that are leaning into what's happened, to your point, using the regulatory actions and consent orders as guidance. I've heard from a few whose contracts with fintechs a couple of years ago were fairly short, are now becoming increasingly longer because they're incorporating these changes into it. So I think it's a topic that I agree with you is not going to just disappear. This is not going to evaporate. It's going to just be taken with a lot more seriousness. And I think understanding of the roles that each party has to play. So thanks for jumping off on that. Let's move to another topic, which I think coincides a little bit, which is banking has just been really challenged. If you think about particularly the last year, but really the last couple of years between interest rates and then some of the failures that maybe cut a little bit at some of this trust and safety question that people sometimes don't want to think about, but it raises its head when you saw some pretty high profile bank failures last year. And then obviously interest rates have changed at a trajectory we haven't seen in our lifetime. So they're dealing with funding costs on the deposit side. They're dealing with margin compression. It's a tough business. And, you know far better than I do, it's also very highly regulated. So, you've seen some challenges. Obviously, we were talking about banking as a service, but in an environment where it's really hard to just do business, how do you feel like regulators are doing where they could overreach, over regulate a lot of these folks out of business in my mind? So I'm just curious how you think they're doing in this really difficult environment.
I'd give them a C grading, if I was looking at this, and sometimes more
Former
harshly.
teacher, which we'll talk about later.
Exactly.
So, yeah.
But I think there's always the right intent of what the regulators are going to do. I think sometimes the regulators get lost in the, all right, this is what needs to happen and this is what needs to change at an institution. And for every change, good or bad, is going to cost a bank money.
Mm-hmm.
Well, we have a lot of things going on that are kind of on the regulatory front right now, but we also have a lot of issues kind of in the macroeconomic environment. 2 and 3 years ago, when we were really in the kind of high life of, fintechs and especially investment and trading, and it just seemed like, hey, everything was going like gangbusters. Those things were all good, but we weren't thinking of commercial real estate as an issue and as a worry. We all knew, and you just kind of alluded to that, interest rates. We knew rates were going to go up. There was none of us that knew that rates were going to go up as quickly as they did in 1 year.
Mm-hmm.
And even I think you and I, as investors, we saw that hit our investments really hard. Now, were we good or bad in doing that? Well, at least for me personally, when you don't know how quick, that is going to continue to go, well, I'll just hold, and I may end up having to take some losses. They're paper losses. I'll write them back out. I think banks got caught in these same situations. Now, other banks made some bigger mistakes with that. But I think kind of looking forward in terms of what the regulators, I think, can do that really help banks are focus on what are the 3 or 4 things that they really need to work on first versus giving them a whole list of here's everything you need to work on. And that sends everybody off into 100 different areas. And they're trying to meet with their customers. They're trying to keep up with fair lending and CRA and all their other things that they're doing and trying to move very quickly to do some of these things. I personally, and I usually don't take a jab at regulators, and I don't know the reasons for this, but this second enforcement action that came upon Blue Ridge concerns me. And it concerns me from the fact that usually during an enforcement action, or if there's different areas, you're looking for a change in management. There was a change in management and somebody very experienced that was able to step in, keep names out of it. There were changes that they were already making that we could read about in their financials, their 10K, 8K in the American Banker that we were aware of that they were doing. And that was really in a year and a half before this second one, this most recent one came on. My concern is that sends a message to the rest of the industry, like, you weren't doing something. And I think banks can always demonstrate that they're doing something. And especially like we saw with Blue Ridge. I hate using anyone as an example because it could be me on the hot seat next year and trying to answer these same questions.
Sure.
But I have seen that there are some banks that start moving on situations really quickly and start implementing the right things, that these things have to be moderated and taken into account. Or if you're sending a larger message to the industry, hey, you need to start taking care of it, you also have to be mindful what this does to the individual institution.
Sure. It feels it feels a little bit like kicking them while they're down kind of approach. And, I know another bank that I'm friendly with self-reported an issue and has gotten very draconian action on them totally from my perspective. And you go like, what's the right interaction? That does this need to be rethought, particularly in a data-driven world like we're in, where, in some respect, like I was just talking to a bank CEO recently who had 24 regulators in the office for a month, and many of them were trainees. And, I laughingly said, well, maybe you should send them a bill for training a bunch of their new people. And not only can they're going to get a bill for the exam. And so I look at it and I go, okay, is it time to really start to reassess this whole thing and say, instead of these point in time, we're going to swarm in and do all this, why not create systems that already exist that have more of a monitoring approach to it? And it just feels like in 2024, that is so possible and could be a much better way to do more individual and systemic analysis much more productively than where we are today.
Well, I think those are the issues, but you touched on the piece first, that when a bank self-reports, to me, that's telling me your systems are working.
Sure.
And as an examiner, that's what I want to know. There's a very big difference between somebody who either doesn't have the systems or the systems are not working to identify risk, and those that are. And those things have to be kind of separated out from saying, all right, we have some good systems over here. Yes, they might be able to be improved. So that concerns me when things are self-reported. Hey, we caught it. Our systems are working. I can trust you, in doing this. And this goes back to each of the crises that we've had before, especially that have affected lending. There's a difference between strong underwriting in lending and poor underwriting. And yet when like 2010 and forward happened, and there were all these issues, even outside of the mortgage crisis, that bankers were having to deal with. And this goes back especially like to late 2000 and then late 90s, when a lot of banks were failing on commercial real estate. There were some of these that were written very strongly. And just because of the economy and other things that were going on, they did everything they could. Things just changed very quickly. Sure. Those are very different scenarios. And I think when regulators can begin to look at that to say, what systems are there? Are they working? Could they be improved? Probably. Every system can always be improved. But did it catch what it needed to do, and yet take a different focus on those that really had very remedial systems? Because going back to our previous conversation, banks that were getting into banking as a service, I think, started trying to build their risk and vendor management and compliance systems all at the same time as they were doing banking as a service. And that's a lot to try to build and learn and take on at the same time. I think that's why, looking forward, banks that are already building their risk management systems are going to have it much easier as they look to expand.
Makes a ton of sense. So any final thoughts? I know I threw kind of a crazy idea out there with this monitoring, more than looking at call reports and things, but more of a always on monitoring approach. Any thoughts you have on what you think the regulatory environment looks like over the next 5 years or so?
I can't even tell you what it's going to look like in 5 years, but I can tell you what I still think is going to happen in the next year. A year ago, I was talking that, we had storm clouds on the horizon and very choppy waters, and you need good navigation equipment to get through that. Now I still see that we have choppy waters, but the sky is clearing up. And that sky is clearing up because interest rates are holding stable. Although we kind of see some indications that maybe it still might tick up a bit, but it looks like they're holding stable. That's given a lot more optimism to bankers that are going out there. So what I kind of see over the next years, and I'm going to sound like a weatherman because I can be partially right and partially wrong, we're going to see some challenges. We know there's going to be challenges that are going to be there. I think we'll even see some failures, God forbid, but commercial real estate is going to have a bigger impact. And I think it's going to have a bigger impact, especially we know in the office sectors. And I think it's going to impact more of the bigger cities, Washington, D.C., which I'm in, Los Angeles, Boston, New York, any of these other areas. I think for a lot of the community banks, they may be immune from that, depending on what else goes on with the economy. But I also think that there's going to be, I think, more progress as the regulators start learning and, are able to describe more. This is what we're expecting in some of these other areas. And I think they've been communicating that. It's just not been heard as clearly in terms of when we partner with a fintech, here's the expectation. To me, and you and I were just discussing it this last week, we're starting to see this much more clearly. You're seeing it from fintechs that you're dealing with, aren't you?
We are, I think, most of the ones that we work with are not looking to work with one bank. They're
Okay.
really trying to help the industry broadly. And it's about helping them become more efficient, more relevant, more competitive as individual banks serving the respective communities that they focus in. And so it is in a number of different capability sets, but I think somewhat different than that single fintech trying to partner with one bank, which is as I think about it, is a line of business that some banks will operate from. But I look at a lot of the opportunity and a good sort of transition for us. A lot of the opportunity is to help make the existing banks that are out there just better businesses. And
Right.
whether that's using the data they have, supplementing the data they have, making them much more technically enabled than what they sort of have been on their own. And I think the thing that occurs to me, and I'd love your perspective on, there's sort of this pressure is to keep getting bigger. And I'm not sure that's always the best advice or strategy, but there is a cost. And you spoke to it earlier, this overhead of being a bank and having this regulatory and compliance overhead is real. And I think some people will say that, there is a minimum size required to be a viable community bank in 2024. And so I just kind of think of it as like, we've got to find that right balance between what's the right size and what's the right overhead that they should bear for being in this business. Just curious your thoughts on that.
And it's a very interesting question because close to 10 years ago, I heard a number of attorneys talking to me as a regulator and said, well, it really looks like that in order to survive in today's market, you're going to have to at least be to 3 billion in assets in order to survive.
Mm-hmm.
And yet we have a number of banks that are 30 million, 40 million, 50 million, less than 100 million, and the majority of them that are less than a billion that are operating and doing it well. But I think you brought up a point earlier. There's a fatigue in the industry because they've come out of one crisis into another. They were just coming out of 2010, 2012, getting their feet about them. Then we had COVID. And then with COVID, we've seen the really acceleration and digitization, like a hockey stick
Yep.
in terms of how that's going. And how do people keep up with that? The challenge for, I would say, an opportunity is for those bankers that really understand technology. They're going to be able to make those choices to move forward. Those that don't also are going to have those challenges on the other side because they're going to continually wait. Well, what's working, what's not? And, there's a good point to know when to wait, but there's also a due date when you've kind of passed it that
Sure.
you're jumping in too late. So I think we've got a lot of issues that are there. I'm optimistic about the future because I think as fintechs are starting to realize those responsibilities, especially if they're going to partner with a bank, I can see a day that they are speaking the same language of the bank and they're doing their own audits. They're looking at their own risk and compliance. And there's somebody from the bank that's able to look at all of that more in detail with a similar expectation, which then makes things safer.
Sure.
But the concern that the regulators have, and that I think any of us have, is banks have gone beyond their core connections. And now they're partnering with more and more people. It's that unbundling of banking. Everything is becoming plug and play. The more apps that we have on our phone, I still try to rid myself of apps I don't use on my phone
Mm-hmm.
that are still sitting there. And I don't know what data they're taking from me or not. And it's the same kind of risk in essence for a bank. Who are they partnering with? To what extent? And when does the risk change? And I just want to make one point there in terms of when does the risk change, is because I think that's one of the important things that banks or fintechs misunderstand, is that when banks are doing an evaluation and doing their due diligence, and as a part of that, their ongoing monitoring, they often look at things as a snapshot. But what responsibility is it of the fintech and of the bank to ask the fintech, what are you growing or when are you cutting back? We've seen just these past few months, this last quarter, that how many fintechs have been cutting employees and reducing headcount. Well, what does this mean for them and their operations?
Sure.
Just as a quick question. And I think when we can establish that internal dialogue, that people are going back and forth to understand how it's going to impact their product, we'll have better and safer systems.
Totally. Some great points there. Yeah, I'm definitely orient as a technophile, having spent most of my career in the software industry. So I kind of always look at it as like, well, software can solve this. The good thing for these smaller banks in my mind always is the cost of technology keeps coming down. And the amount of money that some of these banks pay to their core vendors historically and still, it's just astounding to me at times for the requisite value that I believe they get. And so some of this is, how do we help them take advantage of this broader set of capability that's out there so they can continue to compete? They're never going to spend what JP Morgan Chase or the giant banks do in technology. But to me, it's not just about arms race who can spend more. It's about how you do it. As you think about that for smaller banks, you're obviously on the board of one in that smaller end of the market, at least relative to the money center banks. How do you think about the role technology should play to help them be more efficient, more competitive, et cetera?
It is a great key question. And I think the role of technology overall is to really improve the efficiency and the effectiveness. And I think once you start improving the efficiency, you can do more with less. We all know that with our phones, we can do a lot more than we ever could be. And I can do it just as fast than before when I had to sit and reconcile my bank account and see what was coming in and how much time that took me. It's freed me up to do other things. So I think that role of technology, it will continue to help innovation of the bank. I remember working as a teller in the bank when they were just starting to talk about ATMs. And every teller was worried, oh, I'm going to be out of a job. They're not going to need me. And yet, did that stop traffic within a bank? No. And so I think, again, innovation will continue to proceed, whether, on with the fintech side or AI. It will change duties, but I think when it changes it, the advantage for community banks, it allows them to do what they do better and spend more time with their customers. And that is the value for community banks that they have. And that bankers, and I know growing up watching that, appreciate that. They know that they have someone to talk to. They know that if there's a problem, they can talk to them on the phone.
Absolutely. Well, it is interesting too, the world that I live in and you now as well. I often find, and you sort of spoke to this a minute ago, that sometimes the technology companies trying to help and work with banks and the banks themselves speak totally different languages. Right. Some bankers are really leaning into it, and we certainly have some around us that are very sharp, very forward leaning when it comes to how they think about it. But there is a whole class of folks, and we've seen this in other areas. I remember first getting into business when people were saying, oh, I'm never going to use email. I'll just keep printing out memos and, I'll retire before I have to think about this. But it is in some cases literally a language difference, and the things that you're doing. How do you think about trying to help bridge that gap? I mean, you have a great ability to talk about risk management and those things, but where do you help these folks meet each other where they are?
Well, I think, again, like a company like NContracts and the services and solutions that we provide really help a bank because it augments what they were and takes their manual systems that they had and be able to move it on to the next level. Again, for years, banking was very simple, but yet in the last 10 years, we've seen banking exponentially change. And I'm proud that I've had kind of a really front row chair of watching banks for, close to 40 years and how that transformation is evolving. But especially over these last 10 years, you need systems that are going to be able to help you. You need systems that are going to be able to grow with you. Like with NContracts, when we're looking at our risk areas, I may be a good risk manager and have been doing it for a while, as I'm looking at a risk for a particular area, I may know some of the questions for risk to ask, or I may know the majority of them, but am I going to know all of them? No. When they can use a product like NContracts and have sample templates
Hmm.
to go through, and I can say this applies, this doesn't apply. And those sample templates are updated after every regulatory guidance. So then, a year later, I go through, I'm like, let me see if this is up to date. Oh, I didn't think this applied last year, but we've been asking a lot of questions on it. I ought to include that in.
Hmm.
Or, yeah, that was one of the new changes. Let me include that in. Think of how laborious that is for a person at a bank who's probably doing 3 or 4 other jobs in addition to trying to manage compliance and to keep track of all that, just even trying to do compliance audits, much less trying to keep up with that, and more so on the risk side, because most banks less than $1 billion don't have a risk officer. They've got several different ways that risk is feeding into it.
Hmm.
So I think it's those tools and solutions, but that complexity that we've grown beyond the core, which we just had one main vendor and a very critical one that we had to deal with. Well, we kind of knew and we're starting to see the changes of that. And I think this plug and play is a way of getting out from underneath core vendors or anyone that has control over so much data.
Totally. Well, let's pivot again. How did you end up becoming a bank regulator?
So the short answer is I like to tell people that I've really been in banking my entire life. My father was a banker, a community banker, grew up in San Antonio, Texas. And I just remember as a kid, we'd be somewhere, we'd be coming out of church, we'd be at the grocery store, we'd be at some, festival, and somebody would come up to my dad and said, "Hey, I'm looking to increase my business, or I want to do this. Can I talk to you?" Yes, pick up the phone and call. I would go out with my dad in the evenings when he'd go meet with customers to go visit their business, see what they were producing, and learned a lot from that. I also would end up hearing a lot of times when he'd be doing collection calls from at home and having to have some very stiff words for somebody in terms of, "Hey, I took a chance on you," this and that. So as a kid, I really liked that aspect of it and, saw what was happening. So on the Saturdays my dad worked, I'd go with him because my mom, she was raising 3 hellion boys and we weren't that different in age. So having one of us out of the puzzle made it a little easier. My brothers didn't like going to the bank. They were bored. I enjoyed going to the point that when I was a junior in high school, I started working at the bank during the summers, filing checks and comparing signatures, and started working in back office areas. And then summers, I'd be working there full time. And then during the school year, I was just working there after school. So I began to learn a lot about banking, but I was always impressed with community banking. Now, I did a segue. I was also very impressed with teachers and the teachers that I had. And I saw myself becoming a teacher. So I segued, taught high school for a year and a half, and then started realizing, how am I going to keep up with some of these other changes that are going on? It was a college prep. I was teaching accounting and an economics course, but especially on the accounting, I'm like, how am I going to keep up with these accounting changes if I'm not practicing it other than just reading it? And so I had to rethink my career. I'm like, do I want to go into administration? Do I want to go into this? And I talked to my dad and the CEO. I'm like, hey, I'm actually thinking about coming into banking. And the CEO was former OCC from the 1950s. And everyone he hired, with the exception of my dad, were former OCC. So I used to hear of the OCC left and right as a kid. And the OCC was referred to at that time as the force. Go work for the force for 3 to 5 years, and I will hire you. You'll have a better set of examples of banks that you're looking at, good and bad. That 3 to 5 years turned into 32 years with the OCC, and I enjoyed every minute. It took me from examining in Austin, Texas, for 6, 7 years, then on to Chicago for 12 years, working in compliance and back in safety and soundness and looking at every size of institutions, and then to Washington, D.C. And in Washington, D.C., I became the executive assistant for one of our senior leaders and then stepped into the role in banking relations, where I started becoming the liaison with the trade associations, the ABA and the ICBA and consumer bankers. I also ran and taught the director training program for the bankers that the OCC supervised. So I found myself in a position where I was listening to bankers directly and I could hear their pain points. And I always made it a point to keep their names out of it when I would take things back to the agency. What are you hearing from the bankers? Here are the issues, here are the challenges. Well, where'd you hear that from? Not going to tell you because again,
Sure.
I would see that. So what I saw as bankers came to DC and would ask questions, I really became a good translator because I could hear the question that was being asked on this level. Really what they wanted was here. The answer they were getting was here. And I would ask them for my peers, hey, can you explain about this and how it's going to impact the bank? And doing that. So it was just a natural progression in terms of what I saw, but it was really learning from my teaching background that in order to be a really good teacher, you have to be a good listener. And you and I know that from these conferences, we're exhausted by the end of it, but it is the attention that we have to focus on other people to understand their problems and be able to respond with solutions. It's not just the chit chat that it goes in one ear and comes out the other. So
Sure.
that's the kind of longer history of how I ended up as a regulator.
Well, it seems like you still were able to exercise a lot of that teaching instinct and muscle that you have even through that career. And so it's funny how we always seem to end up in the places that we're supposed to be.
I could see when the lights went on with bankers if they understood something or not, because I always thought the language of the week is for an examiner to, tell a banker, well, here's the law book. Here's what it says in the handbook. Just go do this. Versus trying to explain something and how it's going to impact their bottom line. And I was taught that by, one of the examiners I worked with very early on in my career. Explain the benefit and explain to them how it's going to impact their bottom line. And that became key for me.
That's super useful. I think in so many areas of life, that's very useful is in connecting those dots. And even I think a lot of the best teachers out there are really good at explaining to students why this matters, and not to the teacher, but to their end goals in life. So good, Rafael. Well, you, after 32 years, you did leave the OCC and join NContracts. So let's talk about that. How did that come about?
Well, it was interesting. Michael Berman, the CEO of NContracts, I met early on when he started NContracts. I remember us, meeting and talking, and I'm like, how many customers do you have? And he had 53 customers. And I would see them at different events. And, I began to see more and more. Well, fast forward over time, at one point, Michael Berman said, hey, if you're ever interested in coming to work for us, let me know. And I was like, well, I'm going to finish my time at the agency and then, I'll continue looking. Well, COVID is really what, started coalescing things for me. And I really thought, oh, let me look at retiring. I've done this 32 years. We're in the midst of COVID. I realize our lives can change in a minute. I'm looking forward to doing something different in my life. I didn't know what, but I was also looking forward to saying, these are some of the other things I want to do in my life. And I wanted to have a little bit of a break. That break really didn't happen, but Michael Berman was one of the first to call me. I had a number of different calls. I knew I didn't want to work doing consulting work. I did not want to sit and spend my time looking at loan files and doing a lot of the same things I did in Examiner. So Michael Berman reached out to me at NContracts and basically said, hey, we could create a position for you. Would we really like you being able to do this? And I saw that it was just really a natural evolution of what I had been doing at the OCC and teaching at the OCC, especially in the last job I had, my contacts with the association, bankers that I already knew. And the biggest compliment I got from bankers over my career is, you're not like the other examiners. And it's because I listen. But I also know that when we did outreach as an agency, bankers came by the OCC booth and would ask questions and would usually say, hey, this happened at my bank. What are your thoughts on this? Now, I know that there's always two sides to every story, and I may be just getting part of it. Some of these I would usually say, talk to the examiner in charge, talk to the person at that local office, because that examiner that's working their way up, they're trying to do the best thing that they can. And sometimes they don't understand the gray or the nuances in here. Instead of making a rash decision, talk to them first. Everything is relationship oriented. You and I know that.
Mhm.
So NContracts ended up being just such a great fit. I'll be here 3 years this June. I've loved every minute of it. I love the caliber and quality of the people that I worked with, the OCC. Every company is about the people. And I can say the same thing about NContracts. The quality and caliber of the people that I'm working with in NContracts is second to none. So I really do like it. I'm really impressed with NContracts because of when I came here, we had just less than 200 employees. We have over 300 employees now. We've done several different acquisitions. We just completed one in December when you're seeing most tech companies laying people off. We
Mhm.
continue to grow and doing an acquisition. We purchased one of our competitors, Quantivate. We're coming out with new products. We just announced this intelligent contract assistant that is basically artificial intelligence trained to look at contracts that banks have. And there's a lot of these contracts. And it goes back to that question earlier on third-party risk management, the new guidance. All of the issues that are listed in contracts can now easily be identified through the use of that. And that's going to be an add-on product to our end vendor solution. We've also been for a fifth consecutive year named by Inc. 5000 as the fastest growing company. So all of these things really help to validate
Mhm.
the decision. When I came here, when I started talking to Michael, and first off, before I said yes, I'm like, let me see the products. I need to see the products first because I'm not just saying yes to
Mhm.
anything. And I saw the products and saw these. I'm like, wow, these are really scalable for community banks. I really had not heard anything negative, started doing my own due diligence and moving from there. So I have to say, I couldn't be happier at where I'm at now.
Well, it's clearly been a great fit. And I think, at the point in time of the company as well, for you to be able to really branch out and build a lot of those partnership and industry relationships at a deeper level than maybe they existed before you got there. So yeah, it seems like the perfect role for you at the perfect time. And so congrats on all that. I'm curious, just kind of last bit on NContracts, what are you most excited about for the company or your role over the next year?
Well, the things I mentioned with the growth in the products, this new
Mhm.
one that we just talked about, this coming, we were just selected by ICBA to be a preferred service provider. We've got a number of endorsements from different states that we're working within. Those are listed on our website. We've got more announcements. I think one that'll be coming out this Tuesday, which I don't want to spoil. But the momentum that NContracts has and that we're developing on each side, not just the awareness of who we are as a company, but what our product team is doing and building. And part of our product team, the subject matter experts that we have, I'm just amazed with that it makes it much easier. I'm not the only one here that understands regulation and compliance. I see it differently from the eyes of an examiner. I'm particularly impressed with our CEO and founder, Michael Berman, because he gets these issues and he and I can get together and we geek out. We've got subject matter experts like Stephanie Lyon and Michael Carpenter and a number of others who we can just kind of let's get together and let's kind of pull together. How do we want to say this? How do we want to talk about it? And how do we want to make sure that banks understand and digest our materials?
Hmm. Well, last few minutes we have together, I want to go a little bit deeper on you, Rafael. As you think about yourself, what do you consider your superpower?
My superpower is I would really say I'm a connector. And you've seen
I
me
I agree with
with
that.
that. And I've thought about that for a long time, but I have always been a good connector and saying, hey, I just met this person, this was going on. Being a good connector really requires and necessitates being a good listener. But I'm a great relationship builder and I love people. I love the relationships that I meet. I've had friends saying, don't you get tired of going to these banking conferences? And I said, no, I'm energized by them. I
Mhm.
get to see people I haven't seen and I may just see on LinkedIn and we have a sense of what's going on and we get to catch up. And many of these bankers I've known from some of them who knew me as an examiner going back to Texas and that I'm
Mhm.
still dealing with and that others they knew me as an instructor or an examiner at different points in my career or doing outreach for the OCC. So I've built up this kind of knowledge and awareness, and just because of my smile and presence, I'm used to talking to people. I was lucky at the OCC. I made our booth a destination where most people do not want to stop and talk
Sure.
to the regulators, or if they do, it's usually not kind. It's usually pretty direct and honest. But I would be working with people, and they were like, the minute you step away from the booth, everybody is, hey, is Rafael here? Is Rafael here? Is Rafael here? And like, yeah, he just stepped away. He'll be back in a minute. So knowing that is the same thing. So I would just say that in short, I'm a good connector.
I would totally agree and have seen it firsthand. I think it also takes a bit of an abundance mind to be that way, because you often don't know where that may go, and that's okay. But the idea of bringing people together in relevant and additive ways to make the world better is such I think, a enjoyable way to live, as I think you exemplify.
Well, thank you. And, we were just at dinner this past week, and actually one of the bankers at the end of the table, president of her market, was like, you're a really good connector. And I'm like, thank you. And she goes, how can you keep all these things in your mind? And I appreciate your saying that, because it does take something more than just knowing a name and a company. It's what somebody looking for. And I think that table that we had pulled together that night for dinner was just a great example of it.
Absolutely. I always enjoy when we get to hang out, Rafael. Well, as kind of a final rapid fire for today,
Yep.
let's do some projections, which are always fun to just think about, prognosticate on, and no real accountability here.
Yep.
But what do you think the biggest news will be in banking this year?
I think the biggest news is going to be on both the kind of survivals of how people have gotten through this. I think that the challenges that anyone that is surviving this year and the next, and I think the other biggest news will be growth. We're going to see continued growth in these areas in different banks and how they continue to morph, but how payments are becoming such a bigger part of banking and the connectedness. We've been seeing, a lot of customer to customer. We're going to see a lot more B2B, business to business transactions. I think those are going to be a lot more of the top stories. But I think number one is going to be on artificial intelligence and how people are utilizing it, and just how quickly it has changed in the last, I would say, year and a half of where we're seeing it. And large language models, how different companies and how NContracts is using it, and other companies, but how banks will be able to using that. It's one of those, it presents challenges and it presents risks.
How about on the regulatory front? What do you think the biggest news will be on the regulatory side this year?
I think it's going to be the continued vigilance of whether regulators are looking at and understanding risk. To me, that's been telegraphed through speeches that Michael Hsu has given, the acting comptroller, and he's been talking to banks about guarding against complacency. I think that holds as much true for the agencies as it does for banking. And they're going to be looking very closely. And I think one of that areas for complacency is when things are moving so quickly, bankers have to have a way of digesting that rapid pace of change. And the other part of it is that I will kind of add that as bankers grow, they need to be able to demonstrate that they can grow and they can moderate that growth, much like you do a spigot. You can turn it on, you can moderate it, or you can turn it off. And we're going to need to see that. Banks are going to need to see that. So I think, again, that complacency and vigilance is going to be key. And that key is necessary because of the trust we all have in the banking system. I know a lot of people and, have their kids that only deal with Venmo or PayPal outside of the banking system. It's going to take one disruption for them to lose, or, somebody have money in a stored value card like Starbucks. People keep money in there, and then somebody goes bankrupt. And that stored value card that was tied to that company is gone, and that money is gone. People don't think of those other actions. So I like to think that those are going to be some of the other issues. I think blockchain is going, and tokenization is going to take on new meaning away from cryptocurrency as we see that evolve. Fraud is going to continue to be an area that we have to maintain great vigilance around. To me, I think those are some of the key areas.
Thank you. One thing that does just quickly occur to me, I mean, we've had some scandals emerge in some of the agencies over the last year as well. How do you envision an accountability and vigilance there that you feel like the private sector gets, the banking sector gets from regulators, but how do we go back and cause the same level of responsibility and accountability with some of these agencies when they need it?
Well, I think that's where the press still has a good role in
Yeah.
it. We've
Yeah.
learned about this because of the press. And I think the press has been that kind of third estate to kind of hold,
Mhm.
accountability there. And as long as we have a free press that is doing that, we're able to find that out. I do think that every agency is trying to do their best. And yet when you hear issues that happen, at the OCC or the FDIC or the Fed, little things that have happened, it just creates the awareness of, all right, what do we have to do next time to make sure this doesn't happen? Or how do
Mhm.
we have to transform the culture? And that is key. Culture is key for banks and it's key for the agencies and how that needs to be transformed.
Absolutely. Well, Rafael, as I knew it would be, super fun conversation. We could go on for a long, long time as we sometimes do. Thank you so much for joining, for the friendship, for the partnership, for all you contribute to this industry, even in your new evolved role, coming out of the regulatory environment. So I just want to say, again, thank you and look forward to continuing to work together.
Thank you. I appreciate it. You can tell I'm passionate about the industry.
Thank you for listening to this week's episode of Operate Podcast. If you like this conversation, as a favor to me, you can rate us, review us, or subscribe, or tell your friends. You can also reach out to us on Twitter at Operate Podcast. Until next week, get out there and operate.